Good day, colleagues. Good day, everyone. I hope we are all good. We're all safe. Uh, we're all well in this pandemic. Um, if you have been affected by this pandemic, not financially, but in your health system, I wish you speedy recovery. But I hope everyone here is safe and hence you are able to view and listen to this video. And I hope again that the PDF that I sent in this very channel, it is helpful, and I guess that you took out important notes. Um, in every book that you read or any PDF that you read, you have to highlight only the important things, and it is advisable to do so. I will not blame you if you say, hey Njablo, the only thing that makes sense is only 2 lines and then the rest is just garbage. I will understand that, because I'm one person also who even now still summarizes every book that I read. I only take the important notes and write them down. So in the PDF also, I guess you took the important notes. If each and every word there that I typed, it's of value, then I'm glad that you find it like that. But if it is not, also I'm glad that you understand things in a different perspective, and you have your right to do so. I will not hold your view to be questionable. Okay. With that said, I sent a PDF with 7 photos, if not mistaken. Yeah, I think there's 7 from figure 1 till figure number 7. Okay, so I still have those photos here. I'll just try to go down, and in fact I will not try to. I will explain them, because typing is not the same as speaking. Whenever you type, your time is limited, and you get tired sometimes with your fingers to type, and yeah, and you cannot multitask whenever you're typing because it requires 2 hands. So now I can do something else on the side while I'm speaking here, but I'll not do that because I need to pay attention here. Okay, with that said, let's start with the first. Please note that I will not um, explain the photos as per PDF, but I'll explain them as they are in the PDF. What do I mean by that? I mean I'll not logically go there. Number them as per PDF. I might start with number 7 or number 4, or I might start with number 1. So just that we all know that these photos are all in there, so that it won't be difficult for you to grab whatever I'm saying. It will be easy for you whenever you're reading the PDF and then watch the very same video, pause and refer there, pause and refer there, so it will be easy for you. Okay, what we see now is gold. I'll come back to this gold because there's something I just spotted here. Let's go to those photos. Okay, we will start with this one. Okay, the labeling is already there, as you can see. PDH, previous daily high; BSL, buy stop liquidity; BMS, break of market structure; RTO, return to origin, or order block, liquidity; take profit 1. Okay, here's the thing then. Here it was NASDAQ. It was very risky to sell here, as I always advise that we should always buy Nasdaq, rather sell Nasdaq, because the selling Nasdaq is just a pullback. Nasdaq is always going up. With that said, as you can see here, this is the previous daily high. This is the swing high. Okay, after the swing high, price came down and then pushed up again. Then we have a swing high that took the previous high. Okay, the, the Therefore, this swing high that took the previous high, it is also a stop hand. This bearish wick is also a stop hand, and it took all those who were buying here. all those were buying their stop losses, or the liquidity for buyers was taken out by this move. Hence we see buy stop liquidity. Okay, so after price came down, what do you see? We have this clean break of market structure here, which we do not have to second guess. After that, we have the move that rejected and pushed down again. But here's the trick: how do we know that this is liquidity and this is not the highest move before price pushed down a little bit further? Okay, here's the thing then. For us to know that this is liquidity and will be taken out, we have to we have this R2O here, or the order block. You can use R2O or order block is fine. uh we have it, we highlighted it. Price didn't come here, and we have a swing high that took the previous high. Therefore, we anticipate price to come back and mitigate this order block and then go back down again. Okay, so this took the whole day, as you can see. It was on the 10th here, and then it happened. That move happened on the 11th. So as I'm saying, the way I trade, if you want to trade the way I do, you need to be patient. Like, you need to be patient, because one thing about me again is that I trade on a higher time frame. You can call me a swing trader, or yeah, whatever terminology that you prefer is fine, as long as it's not an insult. Okay, I'm joking about that. Yeah. So the reason why we know that this liquidity is simply because we have this order block here that price didn't come in and mitigate onto it. So after price pushed back down again, so we're definitely sure that this liquidity need to be taken out. So if we're looking on the left somewhere here, I'm definitely sure that there is an order block. There is a bullish order block somewhere here, which we don't know when, that pushed this price up, and then after that it mitigated this order block here. But again, here's the trick again. Do we then stop buying? Do we then stop selling? I mean, after this move happened? No, we don't. And what then do we do? We pull our rectangle further to the far right. And why do we do that? Because we are on a higher time frame, so we need to expand our rectangle a little bit further. So on H1 it might look like we overdid everything, but on a higher time frame like D1 or monthly or weekly, we can see that this was not a lot. Okay, and in fact on weekly, this move is only just one move, and then price moved down. So but on H1 it's 1, 2, 3, 4 and 5 moves before price change the direction. So here our entry would have been triggered, and then price came down, and then again after this, what happened again? And then price moved up again. Okay, so what do I mean that price moved up again? It's clear. It's highlighted here. Price came to the very same order block again, and then it came down. Then after it came for the second time again, here's the secret of this thing. On a lower time frame, we have a risk entry and a risk free entry. Okay, so um if you've been with me for some time, I think you understand now. So this here was a risk entry, this here was a risk free entry. And what do I mean by a risk entry and a risk free entry? Because with this move, though we are 100% sure that this liquidity had to be taken out. We are not yet confident. We are not yet 100% sure that this here the is this order block, will it be a mitigation block or will it be a breaker block? Okay, we are not sure about that yet. Because if we have something like this, low, and yeah, if we have something like this, we have a high, we have a low, and then we have a higher high that took out the is low. We expect price to come and mitigate somewhere here, somewhere here. There's always an order block somewhere here. Okay, so expect price to come and mitigate this order block and then move back up again. Okay, so we also uh, we can also see if ever we have an order block here, it is likely to happen that price will come and violate this order block here, come up and mitigate it, and then shoot down again. Therefore, if this move happen, therefore this is a breaker block. It is no longer a mitigation block, but this will be a breaker block. So hence I'm saying to just enter at this move here, it is a risk entry. Okay, so what then should we do then? We should wait for price to come down and play along here, play along here, play along, and then come somewhere here, come down to mitigate another block that was left here, and then push up again. Okay, so what then do we see? We see we can see the risk entry and the risk free entry. And then on the second entry, you could have used even 1.0 if ever you have some money in your account, depending on on your broker. You can even use 100.0. Therefore, here we are 100% sure that price is going down. Okay, so our take profit will be here. Why our take profit here? Because at the swing that happened before the order block was mitigated, price definitely will come back to that point. The swing low, or the swing low that pushed price to the mitigation block, definitely sure price will come back to it. As you can see, we will have entered here, and then our take profit would have been here, so would have been in profit. So nice. But what then do we do from here? Do we go high with the price? Well, that depend on that depend on what we have here this side. If ever we have a bullish order blocks somewhere, then yeah, I don't see any reason why you wouldn't have pushed the price back up. Okay, so I hope this is clear, guys. This is the definition and the explanation of why this markup on the PDF. Okay, let's go to the second one. Okay, this is only a sketch of how to trade the stop hand and whenever price return to origin. Okay, this is so clear. I don't think I have to understand it. I have to explain anything. As you can see, I here the price that started to move from here. This structure here, the this here is our high, it's our low, it is our higher high, and then price have to come back to the low, which will be the stop hand in this instant, and then we always should, in fact must mark at the start of the stop hand candle, the opening of the stop hand candle. We always should mark it here as our entry and not the 50% issue, because I hear a lot of people say go to the 50% pull your Fibonacci, then it's gonna help you with a good entry. No, always at the open, always on the open. But again, you might think that I'm contradicting myself, because I'm saying I trade on a high time frame. So how are you gonna enter on an open of D1? Well, you have to refine always. You have to refine your stop hand. If you don't see anything, do not force and say you see something. No, don't do that. Just enter on the higher the open of the higher time frame, and then price definitely will go and will come down, bounce, and then push up. Okay. You do not always, mentioned this in the PDF, you are not obliged to always refine your order block. It is not a must to always refine order block. If you do not see anything after you refine, after you refined it, then do not take a trade. I'm urging you, and let me repeat it again. If you do not see anything after you refine your order block, do not take a trade, because it clearly means that price will break this order block, come up to mitigate it, and push down again. So this this all this let's learn to or refine it. And if we do not see anything after we refine it, then do not take and do not take any trade. After the break of market structure, we see that there's a stop hand here, and then price moved up, then the swing high that pushed to mitigate the stop hand. And this is where our take profit is. As you can see, expect price to move high, so we do not have to dwell much on the sketch. Let's go to this to the second one. Anyway, this was for buy only. So for sell is the opposite of the buy. It's exactly the same thing, just that it's opposite. It's sell here, and then on the other side it was a buy. Okay, we cannot dwell much on the sketches. Yeah, let's come to this one, because I think this one has a lot of to do. We have a lot of explanation, and there's a lot of understanding that we need in this photo on its own. Okay, so we'll start here with the break of market structure. Why the break of market structure? Because price came down and then up again, then it broke the structure. Therefore, this is a break of market structure. After the break of market structure, then we have to come down to this candle, the last swing low candle before the break of market structure. Okay, therefore this is a bullish order block or return to origin. Okay, so we have this order block that we highlighted here after the break of market structure. Okay, so after the break of market structure, remember we have an order block here, but price didn't come to this order block here. It just came down to this area here, and then pushed up again. Should we worry that price didn't come down here? Yes, we should worry that price didn't come down here. Also, we have to observe what's happening here. After price rejected this zone, this area here, it moved up again, but it did not take out this previous high. So what then do we see? We see a swing market structure, SMS. We see a swing market structure. This is swing of market structure. This market structure didn't equal this high, or didn't take out this high. Okay, so what then do we do? Uh, After that, price came down and rejected here. Again, price did not come down to this order block here, and this was supposed to be our liquidity. Had price came down to mitigate here, this was supposed to be our liquidity. Okay, Whenever we highlight an order block, we always place a buy limit or the sell limit, right? So if ever you had your buy limit just here, it will not have been triggered, but you should not have to worry. After price rejected here, you have to come here and investigate what happened there. We see a swing market structure that happened first here, then we see a swing market structure that happened below here. Okay, then after that, there's a break of market structure that I did not mark. Let me just mark it here. This is a clean break of market structure. We do not have to guess, as we can all see. This is a break of market structure. So the last swing candle, the last swing high at the swing market structure, we must always highlight the last swing high candle on a uptrend. On a low trend, we always highlight the swing low candle. On an uptrend, we always highlight the swing high, the last swing high candle, okay, which is this one after the break of market structure. So we highlighted that candle. Therefore, we anticipate price to come and mitigate in this candle, which is our order block or 10-202 origin. Then after that, what happened? Price did came up to mitigate this order block, and then remember we have a swing market structure here again. And why swing market structure? It is clear. Price did not come down and take out this low here. Okay, therefore this is another swing market structure. Okay, price did not come down to take this low here. Therefore, what then do we have? Again, we have another last swing low candle before price moved up, and then which is this one is highlighted here. So we expected price to come down and respect this candle here, then move up, and then again, no, notice how this happened. This is on H4, all right, on NASDAQ. This is a proof that NASDAQ is always bullish. Uh, this move, it's in sync with what I'm saying, that NASDAQ is always bullish. So had you had your buy limit here, you wouldn't be in profit from the day that this move happened on the 19th of July here. Okay, yeah, on the 19th of July, and then people will be profiting here. And then again, this is why I'm saying this only applies only when you trade one thing, not the minimum two or three. Only trade one thing. Like, I let me emphasize this: trade only one thing, so you'll see all these benefits. Because if ever you are trading, let's say you're trading Nasdaq and USD and Bitcoin and gold and V75. So should this move happen on one pair or one index, you'll just ignore it, and then you'll wait for your buy limit here to be triggered while people are making money here. And then you'll wait for your price for the market to come down here, so your buy limit will be triggered, and that would have been very, very bad and very, very wrong. It is an ill advice for people to tell you that you know what, you must do at least the minimum four pairs or four indices. That is an ill advice, because if you trade the smart money concept, you need to pay attention. You need to be focused always on one thing. Okay, so let's get back to the chart. With that said, then our take profit after this is clean. It's an open fact that our take profit would have been here. And then after price rejected there, our take profit would have been here. But as we know that Nasdaq is bullish, whenever price came here, we would have moved to break even, so that we are safe. Whether price comes down here or price push up, we would have been in profit. So at break even, as you can see, would have been profitable. Then price will have moved up and form a new higher high that took out the previous high. Okay, price will have been uh, 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 price not would have been price took out the previous high here. Okay, so we have a new higher high here. Okay, so then what do we then? We wait for price to move, because here we did not highlight anything. Therefore, we cannot say what is this candle here. Okay, so I do not have to lie to you. We cannot say this candle is liquidity or something. But in the meantime, again, we can try to force things, but I do not like that, because this is wrong advice to you guys. We can see another break of market structure here. And then after the break of market structure, we always know that the last swing low candle, it is an order block or return to origin, and which is this candle here. Okay, okay, it is so thick. Okay, yeah, this last down candle here, we highlight it up until here. So if we can just drag it up until here, so hence you see price came down to or respected and then moved up. After it moved up, this move high, let's focus on it. This move high failed to take out the previous high. Okay, this high failed to take the previous high. Therefore, what we now have again swing market structure. As you can see, it's labeled there. After the swing market structure, price came down, and when it came down, it broke the structure here. When it broke the structure, then we highlight the last swing up candle in the direction of where the market failed to break the structure, which in this instance, market was bullish. So we highlight this candle here, and then price came down, and then boom, here's our entry would have been triggered. But again, what is this? This is a risk entry, and then second one, we have a risk free entry. Okay, we have a risk free entry, which was confirmed or motivated by this by the liquidity that was left here and up here. Okay, so there was liquidity left here and here, so price had to come up and mitigate this order block and then move down again. Then our take profit will have been this week here. Why this week here? Because it's the one that pushed our second entry or our risk free entry. So this would have been our take profit number one. So this is what is all behind this chart. Okay, so let's go to the fourth photo. Where are we? We are four. Uh, okay, five. Okay, so this year I sent three photos into one and then split them into three for us to understand, not for you only, but for me as well to understand. Okay, so this here is a small version of this photo here. Oops, sorry about. It's a small version of this photo. It is this move. It is this move here. Okay. Uh, this photo here. Okay, so as you can see, the break of market structure with a swing market structure, uh, then we have a we have a high right here. Okay, we have a low here, and then we have a higher high here, and then whenever you spot a higher high, it's evident that there is a break of market structure. Okay, we have a high, we have a low, then we have a higher high. Why higher high? Because it's a new high, and it is higher than the previous high. The way it explains itself is higher high. So this is high, this is a higher high. Therefore, there is a break of market structure. And after break of market structure, we always look at the swing low candle. In this instant, the structure was broken bullish. The market was bullish. It's an uptrend, so we always check the last swing candle for bearish before the break of market structure, of which it was it is highlighted here. Therefore, after this break of market structure, price that started to come into this order block at this week here, not this one or this one, but here. Why this one? Because after the break of market structure, price closed above the break of market structure, not with a wick, but with a body plus a wick. Okay, therefore this candle on its own, should price came down here, you will have taken a sell, and then your take profit one would have been here. Okay, if price rejected there and came down here, this was a good buy opportunity, then your take profit one would have been here. So in this instance it's up there, because this is NASDAQ, and NASDAQ is always bullish. So this is a risk entry anyway. And then we have the second one, which I would have labeled as a risk-free entry. But let's look again at this entry here. Okay, so had we entered the risk-free entry here, and then it's clear that we'll have been at break even somewhere here, and then will have been taken out while price still coming down to our order block. So what do I advise? I advise you to enter on the risk-free entry, which in this instance is number 2. Again, the secret thing in this, the hidden thing is this: is if ever you refined this this highlighted candle, it's clear that there is an order block somewhere down here. That is why price came down and then pushed back up again. Had you refined this, therefore you would have known that all these entries, 1, 2, 3, 4, 5, 6, 7, 8, 9, these were just to entice you, to show you that price is about to come down to your order block. So all the liquidity would have been formed down here, from here up until here. Liquidity will have been formed, which had to be taken out by this move. Okay, liquidity, in fact, not would have been, liquidity was formed here, that was taken out by this candle here. Okay, so had you refined this order block, you should have seen that there is a swing market structure or break of market structure somewhere down here. Hence, price came down. If you refine your order block after the break of market structure and you do not find anything that down here, definitely show your entry. It's up here. But if you refine if you refine your order block and find some good price action here, then definitely your entry will be down here, not up here. Again, your patience will have been tested, because this is H4 NASDAQ, and then the structure was broken on the 4th of August. Yeah, and then this last swing low happened on the 17th of August. So there's a couple of days in waiting, but it will have been worth it, because you didn't have been uh, uh, triggered by these uh, entries up here. Okay, so this is just a light version of this picture here. Okay, so let's go down where we were here now. Let's go to the last one. I hope this the last one. Okay, yeah, this is the last one. Okay, as you can see, this is the second light version of this photo here. Okay, so this move, if you can open your eyes well, you can see that it happened here. Okay, it happened there, but I decided to mark it on its own so that you understand everything. Let's start here. We have this high here with price coming down here to this order block here. Remember, this is an order block on the previous photo. Where is it? Here. Okay, it's this this one here. Okay. Uh, we see price coming down to this order block and then pushed up again. Then price failed to take out this previous high. Therefore, this is swing market structure or failed market structure. Some say it's failed market structure, but I don't see why we should it fail be, because the big boys knows what they were doing, so they didn't fail. It's just a swing high. Okay, so the swing market structure here is the high that failed to take out the previous high, the previous high here. So the break of market structure after price came down to this to mitigate this order block again. We can clearly see the break of market structure, and then the last candle up at the swing market structure, we highlighted price will return to it, and then price came exactly to it, this risk entry. Then price came down, and then price moved to it, this risk free entry again on a higher time frame. This is just one move, 1 2 3 4 5 6 7 8 move. This is just one candle on a high time frame. So our take profit one would have been here, not here. Let's just ignore this one. Okay, our take profit one will have been here. Why here? Because this is the move that pushed price to our risk free entry. Therefore, this was supposed to be our take profit one, and then price came down, and then indeed it came to our take profit. But again, what happened? We are still inside this order block here. Okay, so price moved up to mitigate again the same order block. It returned to origin this time for the third time, three times lucky. And then our take profit two, or take profit. In fact, this take profit two or take profit, it's fine, would have been here. Why here? Because this is the last swing low before price came to mitigate the order block. So price came down, and to mitigate this order block, to mitigate this swing low here. Okay, so this was supposed to be our take profit, and then that's it. In the PDF I sent this thing, I hope we all understand it. And then let me just add something that is not in the PDF. I just see it now. Let's just make sure that all the photos are there, and we explained everything. 1 2 3 4 5 6 photos. I think there's 6 photos there because I see only 6 here. So I want to believe that there are six photos there. Okay, let's go to this gold here. Okay, uh, as usual. Oh, so sorry about that. As usual, we start on a higher time frame and then go down to our entry time frame. Okay, here this is one of the most cleanest chart I've ever seen in recent years in trading, because here you do not have to second guess if is it high or low, is or is an uptrend or downtrend. Here it's clean. Let's just start here. We have a low, we have a high, and then a lower low here, and then a lower high here. Okay, it's clean. Then with this only, we have all the information that we need to take a trade here. Okay, so until price break this here, then gold is bearish. Until price break this level here, then gold is still bearish. Okay, I'll say it again. Until price take out this high, then price is still bearish. Okay, so this the thing I said. I mentioned this on the PDF, that you have to know if price is on downtrend or uptrend or manipulation stage. Okay, so in this instance, gold is on a downtrend. Okay, let's get to work then. As you can see, we have the break of market structure here, and then after the break of market structure, the last swing high is this one here, which was not taken out. Okay, let me use the MT for stuff. Yeah, the break of market structure, and then we have a swing high that was not taken out. But then what we have, we have a swing market structure right here. Okay, the after the swing market structure, what then do we have down here? We also have here the break of market structure right here. After the break of market structure, what do we look for? We look for an order block. Where's the order block? Is down here. Okay, let me just put this in the meantime here. Okay, so okay, there's something again I want to show you. Notice how we have an equal low here, almost an equal low here. Okay, then what is this? This is also a swing market structure, because it is not equal low. I saw some some guy, some colleague of mine on the other side, he marked this as an equal low. But people, please, this is not an equal low. In forex trading, we do not have to force things to be what they are not. We do not have to force them to be what we want them to be while they are not. This is not an equal low. This is also a swing market structure, and then we have the break of market structure here. Okay, so after the break of market structure, what then do do we have? Okay, let me show you something again, that it might look hidden, but it is not hidden. Okay, we do have a break of market structure right here. We do have a break of market structure right here. As you can see, price came down and mitigated this order block here. Okay, remember I said we have a risk entry and a risk free entry. So this was our risk entry. After our risk entry, price moved up. When price moved up, it broke another structure here. Therefore, what do? We extend our rectangle to further here. So price came after price formed the swing market structure, it came down to our risk free entry, and then it took up. Okay, after it took up, what then should we do? Should we refine this here? Okay, let's just refine this order block here and see if price, if do we still expect price to come down here, or this is the only entry that we're supposed to have. Let's go to H4 first. Let's go to H4. There's nothing on H4. Let's go down to our entry time frame of M15. Okay, our entry time frame of M15. What do we have in that order block, so that we know if we should refine it or not. Okay, this is our entry time frame of on M15. This is where I propose you should start M15 before going down to M5 or even M1 if you want to. Okay, we are now on M15. This is another block on D1, right? What do we have? We have this break of market structure here. Okay, after this break of market structure, what then do we have? We have another block, the last swing low candle before the structure was bullish. It's here. As you can see, 1 2 moves this weeks here, they formed liquidity. They did not come down to mitigate this order block here. So what does it mean? It simply means that price, we still have to come down here. Let me just put this 1680.84. okay, 1680.84. Price still have to come down here to mitigate the order block on M15, and then pushed up again. Therefore, here we wouldn't have entered here, because to enter was a risk entry. So price, we don't know if price was just uh, enticing us with this move. Was it gonna still pierce down or just move over up here? So this is what I'm talking about. The patience again would have been triggered. So again, if ever you were trading gold on daily time frame, this move here happened on March, and then on July, and then this order block was respected. But price still didn't come down here. When will it come down here? I also don't know. Okay, let's go down to H4 then. Since we were on daily time frame, we are now on H4. Okay, what's this? Okay, it's there. We are now on H4. I want to show you the beauty of smart money concept, guys. It's beautiful. Okay, what then do we have? We have again a swing market structure here. Okay, which have this order block that is not respected. And then what then do we see again? We have another swing market structure here. Okay, this is another swing market structure. This is a dirty chart that every mentor, every signal provider, if ever they're trading on their own, not using a robot, they have something like this, a dirty chart before they send a buy or sell unto you. Okay, so we have another swing market structure here. Okay, um, that swing market structure inside here. Uh, what have we here? We again, it is a swing market. It again failed to take out this high here. Again, it failed to take out this high here. Okay, so after that, what do? We highlight the last candle that failed to take out the high. the previous high. We highlight the candle that failed to take out the previous high, which is this here. Okay, let's just leave it here for a while. We do not expand it. And then after this, we highlighted this candle that failed to take out that high, right? And then number two, we highlight the break of market structure, which is here. We do not have to second guess. This is the break of market structure right here. Okay, so after this break of market structure, the move that came back to mitigate here was from the order block down here. So this is zone to zone trading. If you ever heard people talking about zone to zone trading, they're talking about something like this. It's from the zone here to this zone. So will it come down to this zone or will it go down to 1680? That is what we don't know. Okay, let's then drag our rectangle further. Remember this rectangle highlighted the candle that failed to take out the previous low. Okay, so if we highlight it further, we can see, oops, we are not in the trade. Okay, but price moved down. Okay, we are not in the trade, but price moved down. Then what happened there? Okay, uh, this is what happened here. Okay, whenever you highlight an order block, always make sure that you highlight the order block. I did this on purpose just to draw your attention. Always highlight an order block that took out that failed to take the previous high, the previous low. That the order block, which is a candle that engineered the move that failed or took out the previous high or the previous low. Okay, so we can highlight here. We can highlight this here as an order block here. This also is what we say macro structure and micro structure. Okay, this here again is what we call macro structure and micro structure. If you can ask me now, where's the macro structure and where's the micro structure? This here, it's macro. Okay, and then this here, it's micro. Okay, this is macro, this is the micro. Okay, so we now identified the microstructure, which has the swing low candle that failed to take the previous high. So now what do we then do? This is what we do now. Order block always order block will always be mitigated by price that failed, will always be mitigated on a swing high or swing low. Okay, order block, did I say order block? Yeah, or order block will always mitigate the open of the candle that failed to take out the swing high or the swing low. If that does not happen, then that order block will be a breaker block. Yeah, I think I said some heavy stuff there. Anyway, this is an advanced in trading here. So what then do we do? The last swing down candle before price changed the direction that failed to take out the previous high is always our order block. The last swing down candle or swing up candle that failed to take the previous high is always our order block. the last swing low candle for the last time before the change of direction, the move that failed to take the previous side's order block. The last swing, which is this one here, this is the last bearish candle here. Let's drag our rectangle further and see what happens. Exactly here. So this was our order block. Price came to mitigate it. Why this? Because this is the last swing low before this move that failed to check out the previous high. Okay, so this is not a random area where price rejected. This was on purpose. And why purpose? Because price was respecting this order block down here. Okay, and again, always look for macro and micro structure. This on macro structure, we are not our entry is not activated, but in micro our entry is activated. I think in the previous 2 or 3 videos I did break down the macro and the micro structure. So after this, we expect price to come down and to our risk-free entry or go down to 1680. But if we go to M15, our entry time frame, let's see then what would we have had. Um, okay, yes, this is our entry. Yeah. Okay, this is the candle that we. Oh no, yeah, yeah. This whole 1, 2, 3 candles is just one candle on H4. Okay. Also again on M15, this is a breaker block. This order block here. Let me delete everything so or that you will see everything clear. We have the break of market structure here, which is not questionable. Okay, we have the break of market structure here, and then again we have another break of market structure here. Okay, so in this macro break of market structure, we have this last down candle here before the break of market structure, and in this one here the last swing is here. Okay, all right, fine. After this, what then again do we have? We have another break of market structure here, guys. This is a break of market structure because the equal highs here were taken out by this candle here. Okay, we have one other blocks, 1, 2, and the third one, and then the third one is this one here. And then the reason why I'm taking this one, not this one, because this has a more of a body than the wicks. This only has the wicks. This has more body than the wicks. Therefore, we take this candle here that has more body than the wicks. Okay, so let's extend our rectangle. As you can see, this order block became a breaker block after it was violated by this move. This order block became a breaker block after it was broken or violated by this move. Therefore, we anticipated price to come back to trade onto it and then goes down. As you can see, what happened after that. Price came onto it, the risk entry, then the risk free entry, 1, 2 here, and then look at the move then that happened after that from here. Okay, so this is all, guys, that I see on 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 gold. Right now, price it's here. We do not know what's gonna happen here. We just have to do the markup or markdown. But remember, 1680.84 is our point of interest from now on gold. So this is all that I see. In fact, I was explaining the PDF, and now I went even a little bit further than that, and or beyond that. So yeah, that's all that I see now, or what I see now quickly before I close, before I end the recording is this here. As we can clearly see, the break of market structure, then the last swing candle with more body than the wick is this one here, is this candle here with more body than wick. As you can see, price came after this the structure was broken. Price came down and respected it, then took up. As simple as that, guys. I hope everything is clear and I hope everything makes sense. This video took me more than 1 hour, so I guess it does not bother you as well. Just make time and watch everything. Pause and repeat where you do not understand. Just pause and repeat where you do not understand. That then ask question where you do not understand. I hope it makes sense, guys. Cheers.